everything to me is like a model. You input, you have the model, you have the output. So a big component in making sure the output is successful is, the jockey. So understanding how they vet opportunities, and also design the process myself. I have a very thorough due diligence myself, from the jockey to the specific investment, and understanding how to put that together. And I spend a lot of time doing underwriting on those opportunities as well.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Micy is the managing partner of Life Mission Capital. She started being an LP in December 2020 and now is a co-GP and fund manager on over 1,000 units as of summer 2022. Micy, welcome to the show.
Thank you. Thank you so much, Sam. Excited to be here. And since our last meeting in the Intelligent Investor Conference.
That's right. We did. We connected there at the Intelligent Investor Conference here in, I guess that'd have been January. Here.
Yeah, time flies.
You were one of the five, I think, or 4 or 5 crazies that got up with me and worked out, I think, at 6 a.m. So thanks.
Yeah, it was pretty intense workout.
We had fun though. You could hang. It was lots of fun. Micy, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
In terms of commercial real estate, I started learning about it March last year. One of my friends told me about apartment investing. At that time, I was struggling with tenants and toilets with my smaller portfolio. That's more personal portfolio. And I was like, oh, let's go check it out. Let's learn about apartment investing, syndications. And I spent about 6 months to 8 months really diving into it, talking to different general partners as limited partners, and see, who are the people I can not only invest my passively money with, but maybe potentially good partners in the future. And I really dove into underwriting. And so from there, I started getting to co-general partner opportunities that I believe was a good fit using my data analytics background. And then fund of fund opportunities, also a great way to scale along with my passive investors as well. So that's kind of what I went to get started and to get to where I'm at today.
That is really cool. That was March of 21 or March of 20 or?
March 21. Mm-hmm.
March of 21. Okay. Wow. All right. So March of 21, you said, hey, I'm going to start becoming a general partner in some of these assets, bringing some investors to those deals. How did you establish confidence in those investors early on that you had? I mean, how did you establish, I guess, credibility is, I guess, the question I'm asking.
Yeah. I think a big thing about when it comes to investment in general, there's 2 pieces. You're finding the right people, but they also do the due diligence on it to make sure the numbers and everything checks out. So as a data analyst, data scientist kind of background, everything to me is like a model. You input, you have the model, you have the output. So a big component in making sure the output is successful is, the jockey. So understanding how they vet opportunities. And also design the process myself. I have a very thorough due diligence myself, from the jockey to the specific investment, and understanding how to put that together. And I spend a lot of time doing underwriting on those opportunities as well. When, as soon as I understood how everything checks out, what the inputs are, how it impacts the output, and who are the people I can talk to verify my numbers, leveraging my mentor, who's a CCIM, also a third-party consultant, who manages, investments for a $36 billion private equity firm. And he does acquisitions, asset management. So once I knew that, I felt a lot more comfortable. It definitely wasn't a battle on my own to say, hey, do it with me. One, partially because I wasn't confident to start with, but second, just having my network as well. My network at the time, I didn't have a lot of people who were doing investments in my immediate circle and who maybe qualified to invest. So I had to kind of create a lot of things from scratch, not just my sphere of influence, but also sphere of expertise as well.
How did you develop a sphere of influence with your passive investors early on?
I showed them basically my expertise, my understanding, because since March, just between March and December, I probably went to 5 different conferences, and also within the local meetups. And I also went into apartment tours, hotel tours. I mean, there's asset class I've been observing for, since last year. This is our second year observing, but we just haven't dove into it without the right sponsors that we felt comfortable with right now. So we're just keeping eyes on many things, but just waiting for the right time to tune in.
Got it. That's really cool. One of the things you had mentioned there was inputs to outputs there in your underwriting, how you want to make sure as a data scientist you get your inputs right so that your outputs come out. Obviously you mentioned, betting on the right jockey, but what do you feel like were some inputs that you maybe think other people overlook, discount, or that you underwrite differently maybe than what some other people do? What are some things that come to mind when I ask that question?
Sure. Some of the thing, especially this year, right, with interest rate changes, that people, maybe beginner investors, take it for granted is the ability to refinance. So can they really refinance within 2 years, not just from a construction schedule standpoint, but from, the level of interest rate change that we could potentially see coming? And if that deal has to have that refinancing in order to hit the IRR, it concerns me. So I see a lot of beginner investors, they don't look at that. They'll see like a sky high IRR, but then how likely is the refinance? So that's like the first thing that came to my mind. And then apart from that, another thing would be the expense ratio, which varies, even in the particular asset class, it really varies by state and different things as well. So how to check maybe corresponding report, local investors you have in the area to really, are those expense ratios, do they make sense? It's a little bit harder if you don't have a property management in the area to tell you, what's the typical numbers, but you can typically get a close enough count to know if they're really off on directions. I would say those are the two things that came to my mind. And then the third thing I would say is just the enter and exit cap right now, right? Like from multifamily, which is kind of my bread and butter, started learning from the beginning, and everything else I do today is housing, because what I look at is I take, multifamily is the core, and then whatever is the difference between multifamily and mobile home parks and RV parks and build to rent, I'm basically taking a deviant of it and say, what are the additional things I have to learn to fill the knowledge gap in that space? Who are the people I need to, have insight tours with, and to understand how this process works, to understand the due diligence gap I need to fill. So, but essentially with that, a big thing that we've been underwriting for the past, maybe 2-3 years, people just write 50 basis point per year in terms of cap rate expansion. But right now, we look at things typically 100 basis point, in entry and exit expansion, at least, if it's a 5-year hold or 3-year hold, or even looking at diversifying the portfolio. So people, a lot of times they just look at returns. They don't look at the risk-adjusted returns. So all that is to say, the third point I wanted to bring back home is risk-adjusted returns, to understand the risks behind those returns that the sponsors are providing, and understanding if it's worth the risk, right? Because like RV parks you're dealing with, it's more, unless you have a large permanent residence in there, you're a lot more daily transactions. Your Springfield portfolio, we get snow up here. So how do you counterbalance those risks instead of just the returns that people see?
How do you underwrite for a risk-adjusted return? How do you even quantify that?
It's really hard to quantify. It cannot, because it varies by market as well. Today's market, right? We look at multifamily, you typically having more of a 15% plus IRR. That's a little bit more of the usual, compared to before you can get to close to 20% IRR. I mean, obviously there's some people that can do higher or lower. So if a more stable long-term housing is providing me that type of return, so when I move into RV parks or mobile home parks, for example, of RV, because we're also, been observing hotels since late last year. I've gone to 10 days of full, hotel operations monitoring, looking at how the sponsor look at hotels, look at acquisitions, and it's also short-term rental portfolios. Like the reason I mentioned those is they're more on a daily rate, right? So you're gonna have more legal risks, more daily rate fluctuations, and change of weather, all those things. So it's hard to put a number on it, but mentally, I'm preparing myself, it has to be significantly higher because of those things. At least 20 to 30%, and in some cases could even be higher, right? Like, and then we move into things like crypto mining, which, I haven't dove into in details, but I know some of my partners, they do that, so that's like significantly higher risk. So I think it really varies per person. I feel like it has to be justified to me personally when I think of myself as a passive investor. Try to put a number next to it and say, is this something that I feel like as an intelligent investor, I would put my money towards for that type of returns.
Micy, here's a question for you. It just helped me clarify because maybe I'm not understanding. Let's say there's a deal and and I'm trying to keep this easy, but 20, and I'm not even sure if I can make up an example for this, but let's say it's got a 20% IRR, right? And you're saying, okay, but how much risk is attached to that 20% IRR? And you're trying to find a way to say maybe there's 30%. I'm making up numbers here, 30% or 40% risk to that. And I don't even know how you quantify that, but maybe on a risk adjusted basis, it's more like a 12 IRR. Is that what I'm hearing? Is when you say, okay, what are the likelihoods that I'm taking on more risk in this category, and then how do I quantify that and put it into a model that I feel comfortable with? Is that any of that even make sense, or am I just?
Yeah, it does. So it starts with looking at the baseline, looking at like our interest rate, right? Like what people can get via some of the other alternative investments, from the safest one to potentially the riskiest one, and then kind of within that, kind of where the risk portfolio could fall. And in terms of real estate investments, the bread and butter for me that I can always refer to is multifamily investments, stable housing. So from that, what are the additional risks we're adding on? It's really hard to say, because it's daily rate, which in plus 5% risk. Like I'm not able to really do that yet, but you can kind of see just from more of a subjective opinion standpoint, perhaps. Me as also a passive investor, most of the times investing alongside of my investors as well. How would I feel about it, considering those risks involved? We can't always foresee COVID and, those strange events that may be happening, but just from a normal world standpoint, the likelihood of those things happening, and try to put a number to it to a way that people feel as those returns are adjusted. That's why we expect higher returns when it comes to hotels, senior housing, even RV parks, because you have additional operations involved, more employees. That's also, potentially higher risk, and in terms of employees, and also more daily turnover, things along those lines. But people could argue the other way, but we're just talking about in terms of to generate the same amount of revenue, how much more operations and process you need to have involved. And I have to kind of plug in that I also have a data internal audit background. I worked in data analytics field for internal audit, and everything we do is like risk factors in that position and when I worked in that role. So I think came out of that, I have a different lens when I look at businesses because of that.
I can only imagine that you do. Where are you seeing opportunity right now? I know you've invested in multifamily. Everything you said, you want to focus on things that are housing related, but what are you studying right now, if anything, outside of multifamily where you see opportunity?
Yeah, I would say is mobile home parks, RV parks, and also build to rent. They kind of have mobile home parks and RV parks have, depending on the different tier of RV parks, you kind of have a different clientele, and in terms of income and their lifestyles. And then same thing with build to rent as well. Build to rent, you could also have different tiers. So those are the two things I'm looking heavily at, just because the numbers don't lie. The, housing shortage will have 5.5 million for the next, as of right now, even for the next 10 years, if we try to fill that gap, right? Like even if we overproduce our housing production by 60%, we'll catch up in 10 years. That number is pretty crazy. And people are jumping in left and right. So many institutional investors going into producing housing. And I know RV parks don't always get approved. So, but the build to rent space is booming. So how to tag along and provide returns for our investors while solving a real need out there, whether it's affordable housing or a tier up from there. I think those are the key to solve the problems for the future. And I feel, once the gold is there, people rush into it, even though there's some limited operators out there. So we want to capture that window of opportunity, similar to what we saw in multifamily for the past, 5 years or longer.
Right, right. Yeah, build for rent or build to rent, build for rent. I mean that is quickly, I think, becoming an industry term, maybe, that even a year ago was kind of off. It was just not as well known, and unfortunately, I think we're becoming more and more a nation of renters. And there's just, if there's a need, then we as operators and as real estate professionals are here to fill that need. So, build to rent, I don't think is going away, and I think it's only going to increase. How have you found the right operator, the right person to work alongside in the build to rent space that makes sense for you while scaling your business?
So I'm actually still I would say, in terms of the research I need to be done, I'm probably still at the 20 to 30% mark in finding that operator and the opportunity. So I have some from my local sphere of influence. I don't mean physically local, just mean virtual network as well. Actually, one of the things I'll be doing, this month, because for me, build to rent, I probably won't be working on that this next month, and maybe a little bit later down the road, like sometime later this year. So I'm kind of just building up additional references and who to work with. It may, sometimes it's about building a relationship. May or may not be the right timing due to various reasons, but understanding how that works. About the asset classes, build to rent is probably one area, which is building construction in general is probably an area that I'm potentially being interested in being more of an operator on. On the other side, I'm more interested in just working with already experienced partners in doing that. So it's also intentionally planting a seed for potentially in the future.
That's awesome. I love it. Micy, this has been a great time. I've loved learning about your business, the way you've scaled quickly, bringing the data scientist approach to underwriting, to vetting sponsors, to looking at potential asset classes. I think there's a lot here to learn from you just in the very quick way you've aggregated all this data and made sense of it. I mean, it takes to the rest of us a lot more time, I think, to figure some of this stuff out than what it takes you. So you've got a natural gift for it. I love to see what you've done with it. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Yeah, thank you. Go to my website, lifemissioncapital.com. There's several ebooks. One of them is called 110 Questions to Know Before You Invest Passively in Real Estate Syndications. So that's a great way for people to scale in commercial real estate as well. Definitely check that out. Otherwise, my website also has my contact information.
Awesome. LifeMissionCapital.com. Micy, thank you again for coming on the show today. I certainly appreciate it.
Yeah, thank you so much. Thank you, Sam.